Vanguard just released their economic and market outlook for 2024. It's a report that they put out every year. It's one that I look forward to reading. It's chock filled with good information, but every now and then there's something in the report that I not only disagree with, but I disagree strongly with. And this is one of those years. So I know Vanguard is a popular custodian with my viewers, so I thought this report would be of interest. And I also think the piece that I disagree with is important. And whether I'm right or wrong, it kind of illustrates how we should be thinking about our investing in an uncertain world. So let's jump in. You know, the real value to me of this report is Vanguard has their PhDs, has their economists look at the US market, look at the global market, and come up with forecasts for what they think the various equity markets, the various stock markets around the world, what they think the returns are likely going to average over the coming 10 years. And I'm just going to focus on the US market for the most part. But let's jump in and talk about, you know, what does Vanguard think the stock market's going to do, right? I mean, it's something that's important to all of us. We're saving money, but remember, it's not enough to save. We also have to invest it, and we want to invest it wisely. So let's look at some of this data. Okay, Vanguard's forecast for the next 10 years, looking at broad US equities, their forecast is the returns are going to be between 4.2 and 6.2%. with a volatility of 17%. And the volatility is just the bumpiness of the ride along the way. So 17% volatility is pretty bumpy. And 4.2 to 6.2 returns are not that strong, right? And basically Vanguard's argument is the US market has had such strong returns over such a long period of time. There is going to be a reversion to the mean that really is going to be driven by a more restrictive monetary policy. In other words, you know, we're not going to be able, during COVID, we were sending out stimulus checks to people. And then we had the Inflation Reduction Act, which is reinvesting in our country's infrastructure, and projects like that and spending like that. Vanguard would say is going to have to slow down. And importantly, the U.S. economy, while interest rates are, Vanguard and I agree on this, you know, we've likely reached peak interest rates. But the question is, are interest rates going to come down to a level that they were in the previous decade? And Vanguard's assessment of that is no, they're not. And I think most of us agree with that, right? We had a decade of very low interest rates. It could happen again. Interest rates are one of the hardest things to forecast, but it's unlikely to happen again. We hope it happens again, but the odds are against us. So let's keep looking at these equities. But I did want to point out that's a low number for US equities. I'm more optimistic than that. Okay, for global equities, Vanguard is saying a little over 7%, 7.1 to 9.1%, about the same standard deviation, 18.3. And then emerging markets, which are economies that are not as big as the US, Canada, Japan, Germany. These are emerging markets. They tend to have a lot more risk, but over time they tend to outperform because of that increased risk, and because when these emerging markets gets their infrastructure in place, it has an outsized benefit, right? There's very few infrastructure projects in the US that are going to pay huge dividends. Those have already been done. Many of them have been done. But in emerging markets, you know, they don't have the highways in place. They don't have the airports that they need. They don't have the ports for the ships to come in. And those types of infrastructure projects have big paybacks. And so that's why emerging market tends to do better over time. Vanguard's forecast over the next 10 years is the returns are going to average 6.6 to 8.6% with a 26% volatility. That's a lot of volatility. And I look at that and say, well, why would anybody do that when they could get global equities and get a higher potential upside and a higher low end on Vanguard's report and have dramatically less volatility, right? But let's keep going. If you look at the global markets outside of the US, so the previous global number was everything. It was global, including the US is part of the world economy. So this global index takes the US out. And Vanguard is predicting 7 to 9% returns with a standard deviation of 16.7%. Now, I do want to say that there is a narrative with this report, right? I'm just sharing the numbers, and I also shared high level. It's this restrictive monetary policy is one of the things that Vanguard is looking at, saying that these returns are coming down. But importantly, I'm going to leave the entire report in the show notes, so I encourage you to look at it. But let's keep going. For U.S. value stocks, Vanguard is anticipating a little less than 5%, 4.8 to 6.8%. And I'm going to quit reading the standard deviations, but I'll show them in the video that we're watching here. Okay, U.S. growth, Vanguard predicts 1.2 to 3.2%. That's a really low number, right? And so these are companies in the Russell 1000 that have more growth potential. And Vanguard's argument there is, it's a regression to the mean. They've had such strong returns. But again, that number is 1.2 to 3.2%. Large cap is going to be Vanguard's forecast is 4.2 to 6.2. And then U.S. small cap, which like emerging market, these are smaller companies, they're riskier companies, but they could be entering new markets, they could be creating new technology that has big returns. So in theory, the return should be higher. It's likely going to be a bumpier ride, but let's see what Vanguard says. Vanguard says 4.9 to 6.9%. And then the U.S. real estate market, they're using REITs, Real Estate Investment Trust, REIT. They're predicting just under 5% to just under 7%, 4.9 to 6.9%. So these are the risk assets, right? Equities, real estate. Let's talk about the fixed income. What is Vanguard seeing on fixed income? So U.S. aggregate bonds, and all these definitions are going to be in the report that I share in the show notes. 4.8 to 5.8%. Now you can see the standard deviations on fixed income are quite a bit lower than what they are in equities and stocks, which makes sense, right? Most of the time, bonds are not going to be as volatile as stocks. I say most of the time because sometimes they can be, and actually in 2022, they were down about the same as equities, which is why 2022 felt so painful to so many retirees. Is the bonds are in there primarily, or at least for my clients, the bonds are in there to buffer volatility. And in 2022, there was more volatility than in years in the past. So the 60-40 mix did not provide as much protection from that bumpy ride. Okay, U.S. Treasury bonds, and those are 20 to 30-year duration, 4.4 to 5.4%. I think that's optimistic. I think that's a big number. So we'll see. That's one that I disagree with. And then U.S. intermediates, these are corporates again. So intermediate term, intermediate duration, 5.2 to 6.2%. And then what Vanguard is calling U.S. cash. So, this is a proxy for what can we hope to get in our bank accounts. This is actually 3-month treasuries. And Vanguard is predicting that 3-month treasuries will continue to pay out the 4.1 to 5.1% on average over the next 10 years. And then importantly, U.S. inflation at 2 to 3%, which is great. We all hope that we hit those numbers. Okay, now let's talk about some of the economic data. We talked about the why, where these numbers come from, but Vanguard's prediction of growth for the United States is pretty low. It's a 0.5 percentage point. Their core inflation number is right in the range that I would think. Maybe I might actually be a little bit higher on what I think inflation is going to average over the next 10 years. I hope Vanguard's right here. They're saying 2.3%. Unemployment, which is at historic lows as I record this, they're predicting that unemployment is going to go up to just under 5%, 4.8%. And importantly, Vanguard thinks that a soft landing where we avoid job losses, we avoid a recession, as the Federal Reserve raised interest rates to try to slow economic growth. That's a really tough needle to thread. Very few times can we get a soft landing. It looks like we might, And I think the reason we might avoid a recession this time around is the job market was just so strong at the beginning of this, and the consumers had excess cash to spend. So even though we didn't feel as rich, we didn't feel as flush, even though we saw some of our neighbors, God forbid, I'm sure some of my viewers lost their jobs as well. Even though some of us lost our jobs, in general, the consumer kept spending, which propped up the economy. The consumer is 2/3 of the US economy. So keeping the consumer spending is key to avoiding a recession. And for all those reasons, that's why I think we might avoid a soft landing. Again, Vanguard says no. So what does all this mean for your investing? What all this means is there's always stuff to worry about, right? If you look at any 20-year length of time in our history, there's all kinds of events that are very scary, whether it's the Gulf War or the dot-com bubble bust, or the financial crisis or COVID, right? But people that stayed invested over the long term, it's time in the market, and it's really hard to do that. And because it's hard to do that, you have to look at your asset allocation, your mix of stocks and bonds, and say, okay, well, just because Azul says when the market goes down, it's going to come back, and this is a buying opportunity. Forget about what I say, right? The market always has come back in the past. I believe that long-term investors are going to be rewarded, but I also believe it's going to be a really rocky road. So what should we do? We should have a long-term asset allocation that we're willing to stick with. I suggest that you work with a professional. Nothing I've shared in this video is advice for you specifically, but I suggest you work with a fee-only financial advisor that is a fiduciary to you 100% of the time. You can just Google that term to find one near you. But your asset allocation is likely going to determine 80% of your success. The other huge factor is your behavior during market upturns and downturns. So, if Vanguard's right, if unemployment does rise like that, things could get scary out there. And then Vanguard's numbers for U.S. growth stocks at 1.2 to 3.2%. This is why you have a diversified portfolio. Does it mean you shouldn't have U.S. growth stocks in your portfolio? I don't think that's the case. I think it's the case that you want to have a diversified portfolio because Vanguard might be wrong, in which case, you'll be glad that you have some exposure to it. On the other hand, Vanguard might be right, in which case you'll be glad you're diversified. So as we get older, winning in our investments is as much about not losing, right? It's as much about avoiding mistakes. And one of the biggest mistakes any of us can make is to become a forced seller in a down market. Now, how do people become forced sellers in down markets? It happens when it's so scary you can't sleep at night. And this has been going on for weeks or maybe months. And you say, this asset allocation just isn't right for me. I need to get rid of some of the equities. It's just too painful. The time to do that, the time to think about how painful a 30, a 40% or more stock drawdown is going to be to you, the time to think about that is now. As I'm recording this, the U.S. stock market is at or near all-time highs. The time to rebalance is when the stock prices for the stocks, for the equities that you own are high, not low. So that's the key takeaway that I hope you get out of this is, good information here. There's lots of smart people. We don't know if Vanguard's going to be right or wrong, but you can win whether Vanguard's right or wrong by having an asset allocation that you can stick with, by having a long-term plan and working towards that plan. And most importantly, when you reach your goal, then reward yourself. Reach out, grab that brass ring, and actually retire. Thanks for watching this video. I also want you to watch this video here. On that note, 5 reasons to retire as soon as you can. I'll see you in there. Bye-bye.